Hi, hello everyone. My name is Graham Madison. I'm a senior analyst at Water Tower Research in the industrial and sustainability practice. Very happy to have today with us Steve Sanchez, who's the CEO of EVmo, ticker YAYO. So with that, I'll turn it over to you, Steve.
Thank you, Graham. Hi, everyone, and thank you for joining us today. We're very excited to be part of this conference and have an opportunity to share our story. This is actually the first time that the new management team has done an investor conference, as we've really spent the last 12 months or so with our heads down focusing on execution. But now we're at an amazing and exciting inflection point. Turning to slide 3, EVmo is a provider of rental vehicles mainly used in the rideshare and gig economy space. We bridge the gap between people who want to drive for Uber, Lyft, DoorDash, or other gig platforms, but either do not own a vehicle or have access to one that meets the requirements of the rideshare and gig companies. Today, we have a fleet of over 1,000 vehicles and on our way to a fleet of 2,000, then 4,000, and then beyond that. In 2021, we announced our plan to shift to an all EV fleet, and that is something we are continuing to make progress on. For example, we've added over 100 Tesla Model 3s so far this year, but it's a balance and really comes down to where the cars are going. In LA or San Francisco, there's a lot of EV charging infrastructure today. But as you look at other areas, like outside the cities in Illinois, the charging infrastructure is not there yet. But as it comes, we'll be rolling in more EVs. One thing that makes us different from others is that we own and maintain our own fleet, which is important as it gives us control over the vehicles to make sure we have them when we need them and that they meet the standards of the rideshare and gig companies. We strive to make it easy to rent, drive, and earn. We offer short and long-term rentals, and more than 60% of our drivers are in the vehicles for more than 80 consecutive days. We provide insurance and do not require a major credit card to rent, which differentiates us, as there are a lot of potential drivers who might be facing credit challenges that limit their ability to access a vehicle. EVmo enables them to have and run their own business. Moving over to slide 4. We're a play on the rapidly growing rideshare gig economy. As I'm sure everyone is aware, this industry has seen massive growth over the last years, and there are multiple studies calling for continued industry growth. We've been called a kind of a pick and shovel play in the gold rush growth of the rideshare and gig economy. Looking at slide 5, this gives you an overview of how our product works. Any driver can access us via our smartphone, app, or website. We're able to get you set up in minutes. Drivers can browse through, see our fleet of available vehicles, book online for terms that fit their needs, and they can make adjustments through the app. As I said earlier, the majority of our drivers are in the vehicle for more than 80 consecutive days. These are people using the cars to make a living. All of our cars are equipped with telematics, so we can keep the car serviced and running right. So it's a very easy model for the drivers to work with, and if necessary, we can disable a vehicle remotely. Looking at the competitive landscape on slide 6, usually when people think of the rental car markets, they're focused on the Hertz or Avis or maybe even the Penske or Ryder trucks. But these are different models than EVmo. They're focused on the business traveler or vacation spots, making sure they have cars at an airport in Florida for spring break, and most rental agreements prohibit using the car for rideshare. Some of the major rental companies do have limited rentals aimed at the rideshare space, but there are still credit hurdles that make it challenging for a lot of drivers. Then there are the car sharing companies, and a lot of investors ask us how we compare to hire car, as we are both providing cars for rideshare drivers. But what's different about us is that we're not peer-to-peer. We own and control our fleet, and that's a very important distinction. With EVmo, we are a fleet management and logistics company at our core with a focus on providing a solution to our customers, and that is a well-maintained vehicle that meets the standards of the rideshare companies and is available to our customers on flexible terms that meets their needs. If you look at the studies of who is the typical driver, a very large percentage are people who have immigrated to the US or are supporting a family and they need the flexibility that rideshare driving gives them. We enable them to earn a living and run their own business. Turning to slide 7. As mentioned earlier, this is our first time speaking to investors. However, the company was founded back in 2016, originally called YAYO, which is why our current ticker is YAYO. There have been a number of changes since the founding, but really the transformational piece happened in mid-2021 when well-known investor Taryn Pizer took a majority stake and became executive chairman. In conjunction, the founders stepped down and a new team came in, led by me and our CFO, Ryan Satoff. And we have added a number of others who have been in and around the fleet management and logistics industry for many years at companies such as UPS, FedEx, Amazon, just to name a few. Our first order of business was to stabilize the operations and set the company on a path to sustainable growth. On the financial front, in January 2022, we completed an equity raise of $13.7 million, which then allowed us to go and secure non-dilutive financing for more vehicles. Again, another advantage of owning the vehicles is that they are real assets that you can finance. That's typically how we do it, as it's more capital efficient than paying cash outright. The chip and car shortages over the past year and a half have been challenging, as have the rising interest rates. We're working through that, both through partnerships with lenders and manufacturers such as Tesla and being opportunistic. As you may have seen, on October the 3rd, we announced a partnership with Truck World USA, which is a big step for us. For those of you who don't know, Truck World, they are a company that is focused on providing non-emergency medical transportation, helping people who can't drive or don't have a car get to a doctor's appointment using a rideshare-like model. They have partnerships with multiple states and some of the major health insurance companies. We're starting with 20 cars in Illinois, but we have plans to expand that significantly. It also grows our corporate services, which are multi-year agreements that will provide a nice balance to the medium to shorter term rental business. As well, these corporate contracts give a great beachhead for entering and then expanding into new markets. Lastly, we reported positive EBITDA in Q3 2022, a milestone for us and sets us on the path to profitability in the coming quarters. Looking into the future, one thing we've been working on for a long time and has been quite delayed, but not by us, is getting FINRA approval of our new stock ticker to EVmo from the current YAYO. They had been waiting for the final settlement of a class action suit left over from the IPO, which is completely behind us. So hopefully we should have the FINRA approval very soon. Other corporate actions will follow this approval, as our aim is to be eventually listed on a national exchange. We are also continuing to add more cars. We're working with additional finance partners, and our goal is to make sure we are growing in a smart and efficient way. Moving to slide 8 gives you a look at where we are today. California is where we were founded and the home of the rideshare companies, so we have a big footprint there. But Las Vegas has become a strong market, and we are seeing some great growth opportunities in other states, including Illinois and other states where we can grow in conjunction with our Truck World partnership. As we said in our Q2 2022 call, we are now over 1,200 vehicles, and our targets are to get to 2,000, then keep rolling them out to meet demand. Looking at the financial slide, you'll see on slide 9, we've seen strong revenue growth, which is mainly tied to the additional vehicles in the fleet, but also higher rental rates. Our gross margins have been improving over the past year, helped by our fleet utilization rate, which is in the high 90% range. Overall, better execution and around maintenance and fleet operations, and we've gotten new cars at better financial terms in our fleet. We said publicly that in the past that our business model at scale, which we consider to be about 2,000 cars, the company should be generating gross margins excluding depreciation of around 45%, and then EBITDA margins around 25%. We have been at the 45% gross margin for the past 2 quarters, so now it's a matter of adding vehicles to reach the EBITDA targets. So in closing, we're excited about the opportunities ahead. We look forward to executing our plans and being able to update investors as we reach more milestones. Graham, I'll turn it back to you for the Q&A session.
Great. Thanks so much for that great overview and summary. If I could start with the first question, Steve, what's the biggest challenge that you face today as you work to grow the company?
Yeah, I think our bigger challenges are many uncontrollable factors, such as what's going on around us in the macro economy. We know that the interest rates are much higher. Credit markets have tightened. Our down payments are now higher than what we had anticipated. So all of those things around the purchase price of a car, the interest rates associated there too, as well as the down payment, those are challenging in the short term, and we're expecting that in the longer term that we're able to mitigate some of that by bringing on additional finance partners.
Great. We mentioned staying on the economy part. What happens to the company, or how do you see it playing out in the event that we have an economic downturn, if the current conditions do actually become a recession?
Yeah. So Graham, look, when we were in the COVID lockdowns, we actually saw that there was an increase in activity. So people still need to get their hot food and groceries and rides to wherever they may need to go. And we haven't seen a recession when it came to, that type of tightening. So I don't anticipate that there's going to be continued hangover from, a down economy for the rideshare industry. We still see very, very strong growth, and we still see very strong indicators that the driver demand is still quite high.
I mean, to that extent, with it, you'd probably see an uptick, maybe even in the number of drivers looking to drive for rideshare.
Yeah, and it's interesting because we've made a real conscious decision to diversify our approach. So we are looking at the gig economy, but as we mentioned with like Trek World, just as an example, we're looking at other ways where we can rent more cars in a single booking session. Like through big partnerships with municipalities, universities, as well as private partnerships such as Trek World.
So you talked about growing in new markets. Can you talk a little bit about your strategy there? How do you balance going into a brand new market versus putting additional cars into an existing market?
Yeah. So look, what we're really trying to do here is saturate the existing markets. We have experience, we have infrastructure, we have people, we have economies of scale that we can tap into. People are now knowing who we are, so that brand recognition message is out there. And as we get the brand recognition to meet the driver demand, which meets the overall ride hailing and gig demands, we believe that that's really the first part of our expansion, is to get more deeply saturated and penetrated into the existing markets. Take Los Angeles as an example. We're in LA, but there's Los Angeles County, San Bernardino County, Orange County, Ventura County, and then we go a little bit further south, and then we're in San Diego County. So we need to really exercise our muscles there and make sure that we're as deep into those markets as possible, and then expand out. And as we expand, obviously we're going to follow the early adopters for tech and all things kind of sharing. That's kind of the stimulus behind our business. And so, Texas and Austin in particular is a very, very interesting market in that there are a lot of early adopters. There's a lot of new engineers going down there following the tech craze that has ensued in Austin, Texas. So, that's one market that we're really looking at very, very closely. But I think in the short term, Graham, our real focus is to get really crisp and very, very good in the markets that we currently serve.
Got it. Yeah, no, I mean, Los Angeles is like 5 cities in one, actually, the way it's so spread out versus something like Boston, where it's just one simple location. But can you talk a little bit more about the partnership with Trek World, in terms of the potential and then what it could mean for you?
Yeah, I think that the partnership is strong, and what we're looking to do is expand as they expand. So right now, Illinois is their beachhead, if you will, and then they're going to expand beyond there to other states. And as the insurance partnerships that they have kind of facilitate that growth, we're going to be right there with them. We are their provider of vehicles, and we see that as a very strong partnership at this point.
Got it. Great. All right, let me just take a couple questions, and this is one that comes in often. Can you give any update on the ticker exchange? What we're thinking there, and then the uplisting after that.
Yeah, look, on the ticker, as I mentioned earlier in the presentation, we're diligently following up with FINRA on the ticker, the symbol change. And we expect that, well, basically we have provided all of the information and requested documentation for FINRA to make a decision on this corporate action. I feel confident that we'll be able to make that. It has been some time since they've had the analysis in front of them, and they've had the information put forward that they've requested. And now we're just waiting for them to respond, hopefully favorably, that we can change the ticker from the YAYO to the EVmo. And again, as I had mentioned, the corporate action, the next corporate action is that, at a point in the future, we do expect to be listed on a national exchange.
Great. But it definitely seems like in the case with getting the ticker change, it's, everything, the ball's in their court. You guys have done everything and gone through all the hoops for them, right?
I believe we have. Just as recently as this morning, I reached out to FINRA personally and asked if they needed anything else. So I do believe that the ball is firmly in their court.
What do you think investors are missing about EVmo?
Yeah, I think that the investors are missing the point about, how close we really are to profitability and self-sustaining. We've come a long way, in a very short period of time. And I think that we're right there on the cusp of profitability, sustaining that profitability, and then self-funding future growth. Obviously, we do need capital put on additional vehicles to get us to the proper hurdle, or over that hurdle, sorry. But I just think that if the investors think about what we're doing from an execution perspective and where we've come from in such a short period of time, I think they'll see that the company is really hyper-focused on the fundamentals and delivering against the things that we can control.
And I guess to that extent, your 3Q results showed very strong operating results, both on EBITDA, gross margin, EBITDA, adjusted EBITDA margin, I think was about 12.5%, about 12.5%, I think, in the quarter, right? Got it. So one last question as we're running up on time. What catalyst can we look for, or should investors be looking for in 2023?
Well, our goals right now, we've kind of created a forward-looking set of agenda items for next year. And among those strategic initiatives is we're focused on partnerships, big partnerships with companies like Trek World, municipalities, more universities. So partnerships are going to be a key component of what we do going into next year. We're focused on profitability. We need to make sure that, we're again, executing against the fundamentals. And I believe that the profitability is going to show itself as we do execute. We've got a whole process documentation playbook, if you will, for every market, for everything we do. And, it's kind of like a franchise model. Whatever we do in Los Angeles, we do in Las Vegas, we do in Oakland, and so on. And I think that efficiency is driving us. The management in those locations don't have to think about their next step. It's already written. It's now about executing, and executing well, and executing with the proper urgency. And not the last and probably one of the most important initiatives we have going into next year is the conversion of vehicles from ICE to EV and hybrid. That's still a core competency and a core dimension of what we do. And we're going to continue to expand that out as we go into 2023.
Great. Well, thank you so much. That's coming up on all the time we have right now. Steve, thank you so much, and look forward to speaking with you soon.
Thank you so much, Graham. Appreciate it.